Hello students, welcome to 2018 past paper discussion session number 5. I would like to kick things off with a lesson introduction. In this lesson, we will discuss the company accounts question of 2018 past paper discussion with relevant exam techniques. Let's get into the session. As usual, first read the requirement of the question and plan our answers. So the requirement is the following financial statements including notes of Hiruka PLC for publication as per LKS 1, presentation of financial statements. First requirement is statement of profit or loss and other comprehensive income for the year ending 31st March 2018. Second, statement of changes in equity for the year ending 31st March 2018. The third requirement, the statement of financial position as at 31st March 2018, and this is a 20 marks question. Remember, we are going to make 3 financial statements for public limited company that we are calling as PLC. Meaning to say is we bound to follow the accounting standards. Let's focus on drafting our 3 financial statements to answer the question. So don't forget, requirement includes notes to the financial statements and also your workings. Let's focus on drafting our 3 financial statements to answer the question. So don't forget, requirement includes notes to the financial statement too. Here are some exam points for students. So the page order is very important to follow the flow of the answer. The first page for statement of profit or loss and other comprehensive income, and the second page statement of profit or loss and other comprehensive income notes, and third page keep for workings for your P&L, and fourth page for statement of changes in equity, and fifth page for statement of financial position, as we don't need to write notes for statement of changes in equity. Sixth page statement of financial position notes. The first mark you can gain from the correct title of your statement of P&L and balance sheet. Hiruka PLC. Statement of profit or loss and other comprehensive income for the year ending 31st March 2018. The first column for note, and we will do the questions in ₹1,000. Always it advisable to do the questions in ₹1,000. It will serve the time for you. And we can draft the P&L. Revenue, cost of sales, gross profit, other income, administrative expenses, distribution expenses, finance cost, other expenses, profit before tax. We need to less tax, then we can calculate the profit for the period. As it is a PLC company, we will have other comprehensive income. And total comprehensive income. We need to provide notes for other income. So the first note for other income, and the second note for profit before tax, and third note we need to provide for the tax. So these are the 3 notes for statement of profit or loss and other comprehensive income. Then we will draft the notes. Note 1 is other income. Then you can leave 2-3 lines. And note 2, profit before tax is computed after charging expenses included following. So you need to leave at least 10 lines here. And note 3 for income tax. So the income tax note, always the format is provision of tax for current year, under or over provision for last year. If we have under provision, we will add that one. If we have over provision, we will reduce that one. Then workings for P&L. Students should provide workings for cost of sales. Then you can leave 5 lines. Then administrative expenses. Then leave 5 lines. Distribution expenses. And other expenses. Then statement of changes in equity. So Hiruka PLC. Changes in equity for the year ending 31st March 2018. Description. Here if you refer the trial balance, we have stated capital and revaluation reserve and retained earnings. So normally we will have opening balance as at 1st April 2017. When we calculate our total comprehensive income, we need to take our profit to retained earnings, and if there are any revaluation reserves, we have to take it here. Closing balance as at 31st March 2018. Then financial position. The financial position, here also you can earn 1 mark for your correct title of the statement. So Hiruka PLC, first line, statement of financial position as at 31st March 2018. So the first column we will leave for note, and second column for ₹1,000, third column also for ₹1,000. So there's a standard format for every balance sheet. So there will be non-current assets and property, plant and equipment. So always we need to provide a note for property, plant and equipment. So the fourth note for property, plant and equipment. Then we can leave some line if it is anything comes under non-current assets. Then current assets. So always start with inventory and trade receivables. Always it will be there. So the format standard, it always there. Trade receivables. Then we can leave 3 lines and total assets. Then after 1 line, immediately you can start equity. And under equity we have 2 items, stated capitals and reserves. Stated capital in this question we have ordinary shares. And leave 1 line. We don't have any other shares. And reserves. So reserves, retained earnings, and also if it any other reserves. So retained earnings. Then leave 1 or 2 line and current liabilities. So we can leave 2-3 lines. Then current liabilities. Always trade payable will be there. And total equity and liabilities. So this is the usual format for balance sheet. So you can always keep this one. Also we will have other payable also. So it's always better to keep that also. And for other payables, we need to provide note. So the 5th note for other payables. The 4th note for PPE. Additional information number 4 outlines the property, plant and equipment details. We can write types of assets information from the additional information 4 table. So we have land, buildings, motor vehicles, office equipment and total. So normally we will have cost. In the cost account, we will have opening balance. Balance asset 1st April 2017. It might be additions, we can have additions. Sometime we can have revaluations, disposals. So these are the items can come under the cost account of the particular asset. So we can take the 1st April 2017 balance and there might be some additions during the year. So it might be some revaluation during the year. It might be some disposal. So these are the items might be come in the adjustments. Balance asset 31st March 2018. Accumulated depreciation, we can have balance asset 1st April 2017. There might be depreciation for the period. And if it is any disposals, we need to remove the particular asset depreciation. Balance asset 31st March 2018. So this is the layout for property, plant and equipment, note number 4. Note 5 is for other payables. So we can leave some spaces. When it comes, we can write here. Read the additional information first. Once we finish all the additional information, we can come back to look into the remaining parts of the trial balance. So the additional information 1. The inventory consists of 3 categories and their cost and net realizable value as at 31st March 2018 were as follows. We have 3 columns informations. First, category of the inventory. The categories are milk, rice, sugar. Since it is a retail business company, these are possible inventories. Second column information is cost of the items in rupees thousands. The third column information is about net realizable value, we are calling as NRV. Meaning to say is net realizable value in detail how much actually we can sell these items at 31st March 2018 in the market level. Almost in every past paper, this NRV adjustment is available. A lot of students lose marks here too. The exam point is here, we cannot compare the total cost of the inventory items with total NRV. Different category inventory items have different sellable value in the market. So make a note here, always we need to compare individual inventory items cost and NRV one by one. Like milk, rice, sugar, we need to compare individual cost and individual NRV and we need to select the lower of cost or NRV according to the LKS 2. So LKS 2 valuation, the milk cost is 4200, NRV is 4400, so the lower one is 4200. Rice cost is 2500, NRV is 2100, so the lower one is 2100. And sugar cost is 3800, NRV is 3900, so the lower one is 3800. Now we need to add 4200, 2100 plus 3800, so that is equal to 10100. So that's a total value. The 10100 is the inventory value we should show in statement of financial position. We actually incurred cost of 10,500 for these inventories, but we should show 10,100 as per LKS2 inventories. There is a reduction in the inventory value by 400 and it is an expense for the company. So here the journal entry to record this transaction is debit record in other expenses because we need to write off the inventory. So we can record in other expenses working 400. Also should from the cost of the inventory need to reduce the 400 to show the actual sellable value in the market of 10,100. So other expenses, inventory written off. At the same time, 10,500 is the actual cost of the inventory. We need to reduce 400. So we need to show 10,100 here. We need to show that inventory written off in the note number 2 also. Inventory written off. So the second additional information, the administrative expenses for the current year consist of the following items. So items in rupees in thousands, salaries paid 2,700, employees trust fund ETF 90, directors fees 1,500, audit fees is 610, depreciation expenses 2,200 and the total is 7,100. So this total should be in our trial balance also. 7,100. So the breakup of that one in the additional information 7,100 is here. Some information we need to show under the note number 2 also. ETF expenses, director fees, audit fees should show under note 2. So we can record ETF expense. That is 90. Director fees 1,500. Audit fees 610. Depreciation expense. Once we adjusted all the additional informations, we can show the depreciation expense here. This 7,100 we can take for workings of P&L. Additional information 3. The salaries included in the administrative expenses represent the net salary paid to employees. Net salary has been calculated after deducting employees' contribution to the EPF. The employer and employee contributions to EPF are 15% and 10% respectively. However, both employer and employee contributions to EPF for the current year have not been paid to the Central Bank of Sri Lanka and also not recorded in the books of accounts. In the additional information 2, salaries paid, it's a net pay of 2,700. But we need to record the gross salary as an expense in the administrative expenses. So we need to find the gross salary and we need to add that amount to make a gross salary. Net salary means from the gross salary we need to deduct the EPF employee contributions. So we can generate a formula here. Net salary is equal to gross salary take away employee EPF contribution. The salary is paid, it's a net pay because in the question itself it says net salary has been calculated after deducting employees contribution to the EPF. Question, the net salary is 2,700. So we don't know the gross salary right now and we need to take away employee EPF. The employer and employee contributions to EPF are 15% and 10% respectively. So 10% is employee EPF contribution. So always gross salary is 100%. EPF employee is 10%. So net pay should be 90%. Calculate employee EPF contribution. So we know this 2,700 net pay is equal to 90%. We need to find 10% of EPF. So EPF employee is 300. Then we can calculate the EPF employer. 2,700 is equal to 90%. We need to calculate the 15% of EPF contribution of employer. So 2,700 is equal to 90% and we need to find 15% of employer EPF contribution. So that is 450. So total EPF is 750. Additional information 3, however, both employer and employee contributions to EPF for the current year have not been paid to the Central Bank of Sri Lanka and also not recorded in the books of accounts. So now we can generate the double entries. We need to add 300 to the salary. To make gross salary 3000, we need to add 300 with a 2700. EPF expenses. Only employer contribution of the EPF is the expense for the company. That is 450. We can't consider employee contribution as an expense because we are not paying. The company is not paying. From the employee gross salary, we will deduct that employee contribution and we will pay the net salary to them. So that is not an expense for company. And the credit entry, both employer and employee EPF, company has to send to Central Bank of Sri Lanka. So the liability is there. So EPF payable, the credit entry is 750. For the salary 300, we can add in the workings of admin expenses 300. So already 2700 is there. So we add that 300. Now the gross salary we have recorded as 3000. Then EPF expenses employer portion also we need to show under admin expenses 450. Then both EPF payable 750 should go to balance sheet other payable. Also EPF expense 450 will go to note 2. Okay, that's all for additional information 3. So we'll move to the additional information number 4. The composition of property, plant and equipment and the accumulated depreciation as at 31st March 2018 was as follows. So there are 1, 2, 3, 4. There are 5 columns of information. In the description, land, buildings, motor vehicles and office equipments are there. So altogether 4 category of assets is here. An annual depreciation rate on cost. Land, we don't have any depreciation. Buildings 5%, motor vehicles 20%, office equipment 10%. And cost or revalute amount in rupees 1000. So here students should understand these amounts are in 31st March 2018, not in 1st April 2007. So these are the year-end balances. So this carrying amount 65,500 should tally with the trial balance here. This one, property, plant and equipment carrying amount 65,500. Actually that's a breakup. So this is the breakup of that 65,500 carrying amount. So these all details are in the year end as at 31st March 2018, not opening balances. So let's move to the additional information 5. So these are the information we need to use for further additional information. So additional information 5, while motor vehicles are used for distribution of goods, all other property, plant and equipment items are used for administration purposes. So what it means is motor vehicles depreciation should charge under the distribution expenses and other property, plant and equipment depreciation should charge under the administrative expenses. All depreciable assets are depreciated using the straight line method. So simply we need to take the cost 10 times by the percentage. Depreciation for the current year has been provided. So what it means is from the additional information 4, this accumulated depreciation all includes the current year depreciation also. In detail, buildings has its current year portion of the depreciation, motor vehicles has, office equipment has its current year portion. We don't need to charge again the accumulated depreciation. In the additional information 2, depreciation expense 2200. It's here. This depreciation expense 2200 should represent the property, plant and equipment except motor vehicle depreciation charge, because that motor vehicle depreciation charge should be in the distribution expense. That distribution expense is here in the P&L. Distribution cost 9,850 include the motor vehicle depreciation expense for the current year portion. Students, remember all property, plant and equipment for company question should start from the PPE note. So that's the best place to start your PPE. So move on to additional information 6. The land of the business was revalued for the first time on 31st March 2015 for rupees 25.5 million. The land was revalued on 31st March 2018 for rupees 19.5 million for the second time and it has not yet been accounted for. So you must remember the flowchart that I shared with you guys in the previous session. So first start to draft the journal entries from asset account. So we can work on PP note. So first we need to find the cost. We need to find the cost of the land as at 31st March 2018. So in the question itself, it says the land of the business was revalued for the first time on 31st March 2015 for rupees 25.5 million. And also in the cost or revalued amount of the land in the additional information 4 is 25.5 million. No additions or disposals in the land account. So it should be the cost of the land as at 31st March 2018. 25,500. Revalued amount as at 31st March 2018. It's 19.5 million. We are doing question in 1000, so 19,500. So decrease in asset value is 25,500. Take away 19,500. So decrease in asset value is 6,000. So always I used to say start the journal entry for revaluation from the asset account. So we need to reduce the cost account by 6,000 to make it 19,500 revalued amount. So the credit entry land 6,000, because now in the cost account 25,500 as a land. We need to make that to 19,500, that is a revalued amount. So we need to reduce that land account by 6,000 to make it 19,500. So according to the flowchart I shared, we need to search in the first time revaluation as at 31st March 2015. If it is any revaluation gain in the land and it carried forward to our accounting year. So the land of the business was revalued for the first time on 31st March 2015 for rupees 25.5 million. In that time also it might be some gain or deficit of revaluation. We need to find that one. So it should be carried forward for this accounting year. So we can find that one here. Any revaluation reserves. Revaluation reserve on land as at 1st April 2017. 5,000 is here. So now the deficit 6,000, the current year is higher than that 5,000. So our journal entry is like this. We need to debit revaluation reserve. $5,000. And the remaining 1,000 only we can charge to other expenses. If you can't understand these journal entries, we have explained it fully in the previous session. You can look that one. So the other expense will be 1,000. The 5,000 we need to reduce from the revaluation reserves. We need to deduct the land by 6,000. So just apply in the statements. So credit land 6,000. So it should be start from balance sheet notes we need to reduce. If we have revaluation surplus in the first time and the revaluation deficit is now higher than our previous year revaluation gain, then the journal entries debit the revaluation reserve 5,000, debit other expenses 1,000 and credit the land by 6,000. So we need to remove the 6,000 as a revaluation under the asset category. So the carrying value will be 19,500. So from the revaluations, we need to take away 6,000. So that's a minus figure. Other expenses, we need to show 1,000 as a loss on land revaluation. That's a P&L workings. Loss on land revaluation. Then in the revaluation reserve also, we need to take away the 5,000. That's a balance sheet account. So revaluation reserves already there are 5,000 in the 1st April 2017 in the trial balance. So we need to take away that 5,000. So there is no balance, that's still 0. So let's move to the additional number 7. Exam point is here the cost or revalute amount. So the cost amount of building 28,000 is adjusted for the 4 million of construction. Meaning to say is this 28 million include the 4 million construction side too. So carrying amount of the building in the note should equal to this 20 million. So 28,000 balance as at 31st March 2018 cost account because it's already adjusted the 4 million. So the addition for this year is this 4,000. So the opening balance of the building we can find from this 28 million is a closing balance. So 4 million is an addition during the year. So the opening should be 24 million. So let's move to the accumulated depreciation part of the building. As per the additional information 5, all current year depreciation has been provided. So the accumulated balances in the additional information include the current year depreciation too. So the balance of the accumulated depreciation is for buildings 8,000. So it's include the current year accumulated depreciation also. So the construction of a new building costing rupees 4 million was completed on 31st March 2018. So no depreciation for current year for the 4 million additions because we cannot provide depreciations since we just finished the construction. Until we use the construction, we can't provide depreciation as per standard. So there is no depreciation for this additional for additions of 4 million. Since the 24 million cost of the building is being used for full year in our accounting period. So depreciation for the period we can calculate for the opening balance of 24 million. And also for the building it's 5%. So 1,200 is a depreciation for the period. And we don't have any disposal in the building. And also that additions we can't charge depreciation. So we can find the opening balance of the accumulated depreciation from the closing balance. We need to take away the depreciation for the period. So from that 8,000 we need to take away 1,200. So 6,800 is the opening balance. So 28,000 take away 8,000. Now the 20,000 carrying amount is tallying. So that also tallying with the buildings here, the carrying amount. The same time we can finish the land also. So the balance as at 1st April 2017 that is 25,500. As we said earlier, there is no additions, there is no revaluations. The revaluation charged we have reduced 6,000. So 25,500. So 19,500 is the balance as at 31st March 2018 of land cost account. And we are not charging any depreciation for land. So 19,500 should be the carrying amount too. So move on to the additional information 8. A motor vehicle costing rupees 2.5 million was disposed for rupees 1.5 million on 31st March 2018. This motor vehicle was purchased on 1st October 2016. This disposal has been properly accounted for and the loss on disposal of the motor vehicle has been recorded under distribution cost. Exam points are here. Disposal has been properly accounted for. So the cost amount of 16.5 million here is after deducting the disposal value of costing rupees 2.5 million. And disposal of the motor vehicle has been recorded under distribution cost. Because in the question itself it says the disposal has been properly accounted for and the loss on disposal of the motor vehicle has been recorded under distribution cost. So meaning to say is we cannot record disposal of the motor vehicle on the distribution cost. So if we had disposal income, we need to record under other income. So disposal loss also should record under the other expenses of the company. So we need to calculate the disposal loss and we need to reduce that from the distribution expenses and we need to shift that to other expenses. So if we have a disposal of assets, we need to think three aspects in any question. The first aspect is we need to remove the asset cost of the disposed asset. We are not going to have that asset longer. It is we need to remove the accumulated depreciation of the assets because we don't have the asset, so no need to keep the depreciation of the asset too. The third consideration is record for cash received. In the disposal. So now we will draft the journal entry. First, we need to remove the asset cost of the disposed asset. So from motor vehicle, we need to remove the costing rupees 2.5 million was disposed. So 2.5 million we need to credit. Then we need to remove the accumulated depreciation also. So that's a debit entry. Motor vehicle purchased on 1st October 2016 and disposed on 31st March 2018. So the period motor vehicle used is 1 year and 6 months. So we need to remove 1 year and 6 months accumulated depreciation. So the asset cost is 2,500 and motor vehicles are depreciated 20% per annum. So for an annum 500. So 1.5 years. So half year charge should be 250. So 1.5 years we need to remove 750 accumulated depreciation. Then we need to record for the cash received in the disposal. So debit record cash. So we have disposed for rupees 1.5 million on 31st March 2018. So we received 1.5 million. So now we need to think for a minute for gain or loss on the disposal. So the asset cost is 2.5 million. That's here. The credit entry is 2.5 million is here. When we purchased. Then until now we used the value of 750. That is accumulated depreciation. So the actual worth of the motor vehicle is so 2,500 the cost we used for 750. So 1,750 is the actual worth of the motor vehicle. So cash received is 1,500. So loss on disposal is 250. So here also you can compare. The cost we removed is 2,500 and the depreciation until now we charge 750. So the actual worth is 1,750, but we have sold that asset for 1,500. So there is a loss. So loss means that's a debit entry in the P&L. Loss on disposal. Is 250. Now the journal entry 2 is telling. So let's work in the JE. Let's work the JEs in the statements. Since all adjustment made, the carrying amount and closing balance should be same as in the additional information 4. So the motor vehicle 16.5 million should be the cost after disposal. So the disposal amount is now we need to reduce by 2500. So there is no additions or no revaluations on motor vehicle, so we can find out the opening balance right now. You need to add that 2500, then it will be 19,000, the opening balance. Then here, if you see the double entry, we need to remove the accumulated depreciation of 752. So under the disposal category, we need to remove this 750. We know the closing balance of the accumulated depreciation should tally with the additional information 4, that is 4500. Now we need to find out the depreciation for the period. So since this disposal happened in the year end, this opening balance should be for the full year during the period. So depreciation for the period should be for the opening balance of 19,000. So this 19,000, normally we will charge motor vehicles 20%. So 20%, that is 3,800. So now we can find the closing balance. So we need to add that 750 and we need to take away this 3,800. So 1,450 is the balance as at 1st April 2017 motor vehicle. So now it should be tally with the 16,500, take away 4,500. The carrying amount is now tally with the additional information for 12,000. So we will move to the additional information number 9. There were no other additions or disposals of property, plant and equipment during the year. So what they are saying is office equipment opening balance is 10,000. Since there is no additions or disposal in the office equipment, so the closing balance of 10,000 should be the opening balance. And also the charge for the period for opening balance, because there is no additions or disposals. Office equipment is 10% charged. That is 1,000. And also we know the closing balance of accumulated depreciation of office equipment, that is 2,000. So the opening balance of accumulated depreciation should be 1,000. And from this 10,000 cost account, remove 2,000, that 8,000. So the 8,000 is tallying with here office equipment. Now we can total it up. $74,000, the cost account of all property, plant and equipment. So 14,500 total PP accumulated depreciation, and 74,000 take away 14,500. So the new carrying amount is 59,500. So now the carrying amount is 59,500 should go to PPE in balance sheet. So disposal loss already recorded into the distribution cost. So we need to remove in distribution cost and add that to the other expenses. So we need to go to distribution expense working. So remove means we need to make a minus figure. 250. And we need to add that to other expenses. So depreciation for the period is right now this row. Depreciation for the period is 1200, 3800 plus 1000. So altogether the 6000. So that's a depreciation for the period. So depreciation expense we need to show in the P&L notes. Depreciation expense 6000. Also this depreciation is already charged, so you can cross check here. The depreciation expense charged in 2200 should be except motor vehicle. So we can cross check here. 1200 for buildings, 1000 for office equipment. So 2200 charged correctly in the admin expenses, and other 3800 already charged according to the examiner's comment. So we don't need to do anything here. The additional information 9. So there were no other additions or disposals of property, plant and equipment during the year. Additional information number 10. The company sells products with a 1-year warranty period. The company has paid Rs 450,000 as a warranty expenses during the current year for sales made in the previous year. This is included under distribution cost of the current year. The provision warranty as at 31st March 2018 has been estimated as Rs 750,000. So provision for warranty as at 1st April 2017 is 670. The additional information says the company has paid Rs 450,000 as a warranty expenses during the current year for sales made in the previous year. So the double entry actually it should be, we need to reduce the liability of provision because we have paid that amount. Credit cash 450,000. But they recorded in debit entry in warranty expenses. We cannot record into the warranty expenses account because for previous year warranty expenses should be matched with previous year revenue as per matching concept. So already it has been provided for previous year as an estimation. So for the current year we need to correct this error. So previous year expenses we can't record in the current year. So correction entries are we need to debit the provision for warranty expense. And we need to credit the warranty expenses. So why we are doing this is we need to we need to provide the double entries provision for warranty expenses. We need to reduce the balance of the liability because we have paid the amount of 450,000, and also we need to credit the cash account. But what they have recorded is they have correctly recorded in the cash 450,000 because they have paid, but they have increased the provision for warranty expenses 450,000, but that expense actually related with the last year's sales. So the correction entries, we need to reduce the liability because actually we don't have to pay that 450,000 anymore. So debit record provision for warranty expenses 450,000, and also we need to reduce the warranty expenses because that is already recorded in the distribution cost 450,000. So that is the correction entries. So first reduce the 450,000 in the warranty expense to correct the error. That is in distribution cost. Distribution cost in the trial balance is 9,850. Then for the current year, company has decided to provide 750,000 for current year sales. Opening provision balance for warranty expense is 670,000. What it means is last year sales, they need to provide an expectation of 670,000 warranty expenses. So that is, we need to provide correction entry in the provision for warranty expenses account. So we need to reduce this 450,000 here. And the closing balance, as at 31st March 2018, it should be 750,000. So the opening balance of the provision is 670,000. So we need to adjust this 450,000 because we need to reduce the liability. So now we have a balance of 220,000. But in the year end, the closing balance of the provision, it should be 750,000. So the increase in warranty provision is 530,000. So now the closing balance of provision as at 31st March 2018, this is for current year sales. They are expecting 750,000 as a warranty expenses. So this is for the current year liability. So this balance, this is actually a provision for warranty expenses account. So the closing balance now is 750,000. So this closing balance will go to balance sheet. So statement of financial position, in the other payable, provision for warranty, that is 750. And any provisions we need to charge only for increase or decrease in the provision accounts. Similar for allowance for doubtful debts. So the increase is 530,000. So that is the charge for this year. So the double entry, debit the warranty expenses by 530,000. And we need to credit warranty provision account $530,000. So warranty provision accounts, we need to reduce 530,000. We already reduced here. We need to increase the warranty provision expense account by 530,000. That is a liability. Already we have increased, and the balance after increase we have recorded in the other payables. So warranty expense is 530,000. Already we have reduced that 450,000 because that is related to the previous year. So this year warranty expense is 530,000 after we have considered the correction entry. So warranty provision in the distribution expense. Additional information 11. The bank loan obtained on 31st March 2018 is payable in 5 annual installments. 5 annual installments of rupees 3,580,000 each, commencing from 31st March 2019. So the installment is going to start in next year, the end of the next year. The interest rate for the loan is 15% per annum. So normally the bank loan, the schedule will be like this. So 5 installments we need to pay. So the opening balance of the loan is 12,000. For the 12,000, we need to pay 15% of interest per annum. So that is 1,800. The annual installments is 3,580. So the opening balance is 12,000. We need to pay interest for that 1,800. And the installments 3,580, it include that interest also. So 10 to 20 is in 31st March 2019, not 31st March 2018, because we need to pay the installment from 31st March 2019 next year. So after 1 year we have passed, our liability of the loan is 10,220. So that is non-current liability, because with not this 10,220 should be paid after 1 year, not within the 1 year. So there is a non-current liability. So bank loans, company needs to provide a clear picture that this much of amount we have a liability as to pay within 1 year and after 1 year period. We have calculated our non-current liability is 10,220 and the total liability is 12,000. The current liability we can calculate from total liability, take away current liability, non-current liability. So the current liability we can calculate. So the total liability is 12,000 and take away 10,220. So 1,780 is a current liability portion. So in the balance sheet under non-current liability, bank loan is 10,220 and in the current liability the bank loan is 1,780. Additional information 12. Income tax paid includes Rs 350,000 paid for the previous year and payments for the first 3 quarters of the current year. The income tax liability for the last quarter of the current year was estimated as Rs 400,000 and it has to be adjusted for in the financial statements. So income tax paid includes Rs 350,000 for the previous year. So the total income tax paid is here. So income tax paid during the year is 1,100. So previous year payment is 350,000. So current year first 3 quarters tax paid is 750. So when the income tax paid, the double entry will be the debit. We need to reduce the income tax liability, the provision for income tax liability account. That is 1,100, the total we have paid during the year. And also we need to credit the cash will be outflow. So this is the total amount we have paid. The income tax liability for the last quarter of the current year was estimated as Rs 400,000. Meaning to say is we have already provided the payments of 3 quarters. We have the liability with the last quarter and it is estimated as Rs 400,000. So for clear understanding, we have an opening provision of income tax liability, that is 450,000. That's in the trial balance. Provision for income tax asset 1st April 2017, 450,000. So during the year we have paid 1,100 and now they have calculated the closing balance should be it should be 400,000. So now in the account, increase in the current year is, it should be 1,050 to make this balance as 400,000. So if you add 450,000 and take away 1,100, this is in rupees thousands. So now 400,000. So increase in the current year is 1,050,000. It means 1,050. So the closing balance of the income tax provision, it should be the balance for this year liability. And also this 1,050 is the current year charge. We need to debit the income tax expense. This year income tax expense. And we need to provide the provision for the income tax liability. So after we pass this entry 1,050, this is the account of provision for income tax. The balance will be 400,000. So income tax payable, $400,000. So the income tax expense it should be in the P&L tax expense. That is 1050. So now we have a note 3 for income tax. So the note 3, we need to apply the provision for income tax for the current year. So how can we calculate this first? So provision for the current year is, we know for the first 3 quarters we have 750,000. So current year first 3 quarter taxes paid, that is 750,000. The fourth quarter estimation is 400,000. That is our closing balance of the income tax provision also. That is 400. So 1150 is the provision for the current year. Over provision we need to reduce. Under provision we need to charge more. Of previous year. So under over provision of previous year. So the previous year, the opening balance is, it means the last year closing balance of the income tax provision, that is 450,000. So for the last year quarter, we have paid 350,000. So 450,000 we have made a provision in the last year, but actually for that last year quarter we have paid only 350,000. So that 100,000 is an over provision. So over provision we need to reduce. So here also we should get the same answer, 1050. We need to show in the P&L notes for 3. So the provision for current year taxes we have calculated 1150. So there is an over provision, we need to less that 100 over provision, 1050. So here also we have got the income tax expense for the current year 1050. We are good at with the adjustments. We will finish the question and the remaining informations, property plant and equipment in the carrying amount. So we have done with that one, and the other one is purchases. So purchases we need to calculate the cost of sales, 41,850. Then trade receivables 22,600. Inventory as at 1st April 2017, 9,750. That we will use in cost of sales calculation. $9,750. Cash and cash equivalents 1,250. Administrative expenses 7,100. We have done with that. Distribution cost 9,850. We have done with that. Income tax paid is 1,100. We have done with that. Sales 83,000. That's the revenue. Trade payables 12,500. Provision for warranty as at 1st April 2017, 670. We have done with that. Stated capital ordinary shares 35,000. So that's the opening balance, 35,000. Revaluation reserve on land as at 1st April 2017 is 5,000. Revaluation reserve opening balance. Retained earnings as at 1st April 2017, 6,880. So the total will be 46,880. Accrued administrative expenses 250. That's an other liability. And bank loan 12,000, we have done with that. And provision for income tax asset 1st April 2017 for the year ending 31st March 2017, and we have done with that one. And commission income 3,250, that's another income. Profit before tax is computed after charging expenses of including following. So some expenses we have missed, so we can write that here. So inventory written off, ETF expense, director fees, audit fees, and depreciation expenses, EPF expenses 450. So in the revaluation, we have a debit record in revaluation reserves. So debit record means we have a revaluation loss. So that loss we need to record. So revaluation loss. So charge in revaluation reserve. So that is 5,000. So that's a debit record. And also that's related with statement of changes in equity. So we are removing that 5,000. We need to show that under note 2 profit before tax is computed after charging expenses of including following. So revaluation loss. Loss on land revaluation. That is 1,000. And the loss on disposal is 250. So loss on disposal of motor vehicle 250. And provision for warranty expense 530 also we can give in the note. So we can finish the workings right now. So we need the closing inventory. For this closing inventory we need the cost value. So the total cost is 10,500. So 41,100 is the cost of sale. So gross profit is 41,900. Another income we can take from P&L notes, commission income 3,250. So administrative expenses, the total is 7,850. And distribution expenses 9,680. Other expenses 1,650. And we don't have any finance cost here. Another expense will be 1,650. So we can calculate the profit before tax now. These all are minus figures. So 25,970 is a profit before tax. And the tax expense for the 31st March 2018 is 1,050. So profit for the period we can calculate as 24,920. and charge in revaluation reserves is 5,000. So the total comprehensive income is profit for the period and other comprehensive income, that is 19,920. So we have completed our P&L. Then we will complete the changes in equity. So here we have worked with opening balances, and in the total comprehensive income, so this is the revaluation loss on land 5,000, and the profit, it will be come under retained earnings. So the profit for the period is 24,920. So the total should be equal to total comprehensive income, that is 19,920. So now we can get the closing balance of each. $66,800. So these balances will be go to the balance sheet capital parts, balance sheet equity parts. So the ordinary share is 35,000. That's in statement of changes in equity. And the retained earnings will come from statement of changes in equity retained earnings columns, 31,800. And we don't have any revaluation reserves right now, so we will tally the statement of changes in equity. So property, plant and equipment, we have done with that one, 59,500. And inventory, we have done with that one. Trade receivables, cash and cash equivalents. So the total current asset is 33,950. So the total asset amount is 93,450. So it should be tally with the total liabilities and equity. So retained earnings is 31,800. Revaluation reserves is 0. The bank loan is 10,220. And we have a trade payable 12,500. And other payable 1,080. It should be under bank loan 1,780, the current portion. Okay. Other payable should come from note 5. So balance sheet notes, note 5. That is 1,750. Okay, bank loan part is 1,780. Income tax payable 400. That's all. So the total current liability is 16,430. So we can get the total equity and liability portion. So 93,450 and 93,450. So total assets is telling to total equity and total liabilities. So we have done with the question, right?